Hey everybody, my name is Justin. Here recently, Uncle Larry and Stockmo came out with their top stock picks to buy right now. So I thought it'd be a lot of fun to take those stock picks, put them in a portfolio, and then track them against the S&P 500 over the next few years. Uncle Larry and Stockmo have similar investing strategies. They're looking for companies that are disruptive in their market, that are big in their sector of the market, that have massive growth or potential massive growth going out into the future. So then I started thinking actually it'd be a lot of fun to actually take other top stock picks, say from value investors, put those in a portfolio as well, and then track that against the S&P 500. So essentially we'll have three different portfolios, Uncle Larry and Stockmo in one, the S&P 500 in another, and then stocks from value investors in another, and then we'll see out of these three which one's going to have the best returns over the next few years. Next, we're going to look at several short clips from investors explaining why they like a particular stock they have high conviction on that would go into these portfolios. After the videos, we're going to come back and we're going to summarize each one of the portfolios and the stocks that are within them, and then those are the ones I'm going to track going forward. So you want to stick around and see that summary. Enjoy the videos.
Trying not to get a reflection. So the first stock that Stockmo picked is DraftKings, ticker symbol DKNG. DraftKings. Let me put these back on. All right, that's Stockmo's first pick. Right now, these are not limited to these four, and all of the YouTubers, these are not limited to these four, but I limited them to 4 stocks. So his first one is DraftKings. His second one is Tesla, ticker symbol TSLA. DraftKings, the ticker symbol is DKNG.
He's going to start with DraftKings. Yes, DraftKings. That is my first of the best stocks to buy now. And I am going to go through what the analysts on Wall Street think of these picks at the end. So stick around. So the first one, DraftKings, I got to tell you why. Anybody who's been following my channel knows I look for stocks that are leaders in the industry and that industry is growing. For example, in the EV charging, I love ChargePoint, but that's not on my top 4. It would be if we had a top 10, but I went with DraftKings because I think the gambling industry is going to be absolutely huge around the world, and I think the winner is easily going to be DraftKings. So if you're not invested in DraftKings and you're looking for a little exposure in the gambling industry, I highly suggest taking a look at it. Do your due diligence on my channel. Like I said, I don't tell you what to buy, I just tell you what I'm buying, and I've been loading up on DraftKings. I'm going to continue to add more and more on, dollar cost averaging into a very big position for the long term. And give me that 10% discount. I'll take this stock at 55 bucks any day. So the next of the best stocks to buy now, I'm going to go with Tesla. It's my favorite company in the world. Tesla brings everything to the table. They got the energy. They got all kinds of different revenue streams that they've been talking about that they want to add in there. And my Tesla stock price prediction, like I said, I had it at 900 this year, 1250 next year, 1800 plus for 2023. If it happens, it happens. If it goes way over, I'm okay too. So in other words, I'm the ultimate optimist on this one. And I do believe Tesla is going to rule the EV market. Their technology is second to none. And there are people out there, the companies are years behind their technology. They have done the hard lifting on this, and everyone else hasn't even started. So when I look at how far advanced they are with their factories and everything else, to me, this is an easy win. Now they're getting, look at the Texas registration they were doing down there for some of the energy. I'm excited to see the different revenue streams that are going to come out with this. And who knows, maybe I get a little piece of SpaceX or an opportunity of SpaceX in the future because I own so much of the stock in Tesla. Maybe they'll open that up to owners of Tesla for being loyal.
Over September, so there will be good businesses if you want more diversification, and Intel is in that business. Why? Because Intel is now, from a cash cow that it was a year ago, positioning into really the growth of the semiconductor industry and really diversifying away from China and the chips there. We are in a chip shortage, as all the news are showing. And then you think, okay, with all the intel that Intel has in that tech segment, will it do good? Is it worth, if we look at the market capitalization, is everything that Intel does, has done, owns, Mobileye, everything, is it worth 215 billion? On a price earnings ratio of 12 and a dividend yield of more than 2.5%, TSMC assumes 15% for the next decade, terminal multiple of just 15, and a discount rate of 10, and I get to an intrinsic value of 248 billion. Thus, for a 10% return, Intel is undervalued.
My assumptions here, they're buying back shares, etc. Pretty much everything else is the same. Analyze button, the stock's currently $51.
Look at that.
This is why I own Walgreens, guys. I look at this going, wait, why am I bothering with CVS? I bought Walgreens at $38 a share. And I had puts, and this is, to me, Walgreens is the answer. Lower debt levels. Yes, their free cash flow was decreasing, but it's starting to rebound a little bit. Bigger locations. I just look at it going, Walgreens, to me, is the answer in the situation. Because it's not like, I mean, their margin's pretty much the same. They're operating the same method.
Yeah.
Right? So I look at it going, okay, they're in other countries more than CVS is. I just look at Walgreens as the better play at this point.
My top four is ticker symbol AAPL, that's Apple. My second one is ticker symbol VOO, that's Vanguard, the S&P 500 ETF. So that's in 3 of our top stock picks, all right? My fourth one, I want to stretch out a little bit, is Tesla, TSLA. Tesla is a game changer. Tesla and Apple are world changers, and I believe that you should have these in your portfolio long term, 10, 20 years. These are retirement stock. These are never sale stock to me, okay? These are set it and forget it stock that you should buy in a bull market, a bear market, a crash, a correction. You just keep dollar cost averaging in these stock, and you will create generational wealth. That's why I asked for this list.
But basically, what we do is we take analyst estimates, we discount that by a required rate of return. In this case, I'm using 7.5%. I've been using 7.5% for about a year because that seems to be a reasonable amount above what we would get in, let's say, something like corporate bonds. And then I used a perpetual growth rate of 2.5%, and that gave us a fair value for Lockheed Martin stock of about $491 per share. Now, Lockheed Martin does have some debt and some cash, so we're going to want to adjust this calculation. When we do that, well, we can see that we now get a discounted free cash flow calculation, our fair value of $455 per share. And given that the stock is currently trading at about $340 a share, well, it looks like people were correct when they said Lockheed Martin looks to be undervalued right now. So, looking at their own history, they still look undervalued compared to where the numbers are today. So if you're curious, yes, I will be personally buying L&T stock in the near future.
So to wrap up the video, I just really think that cannabis is going to grow into a massive industry over the next 4 years. And I also think that Tulieve is going to be a major player in it. Tulieve is an absolute beast with an award-winning CEO. And also, retail investors have an edge over institutions right now because institutions cannot even invest in these companies. I just really think that Tulieve could grow to be a $100 stock or more over the next few years.
Or a normal tax rate of about 25%. In these two scenarios, based on my cost basis of roughly a $5 billion valuation, once again, there's no need to overcomplicate the numbers, just rough numbers are always usually fine. This puts Tulieve at a forward price to earnings of anywhere from 16 to 24 times. And this is in reference to a business that can easily pull off foreseeable long-term growth rates of anywhere from about 20 to 30%.
Stockmo's third list, his third stock on the list is ticker symbol DIS, Walt Disney Company. Okay? That was a surprise to some of you guys, I know. His fourth one is ticker symbol COIN, coin as in Coinbase. Coinbase is Stockmo's fourth stock.
Disney, come on now. How can I not pick Disney? I don't want everything to be super high risk, but I do want everything to go up. And I think Walt Disney is an excellent company. They got the Disney Plus package out there, which I think is going to absolutely crush. It is with Marvel, ESPN. They got all of their programming in there, the Disney classics. You put it all together, that alone is a major growth company, okay? But that's all part of Disney, all right? And you got ESPN shopping out the brand for $3 billion plus for the gambling industry, and the parks are reopening. But we have a little issue right now. There's going to be some waves. I know COVID still isn't done doing its thing, so I'll watch through this. I figure we have another couple months of headaches here for Disney, but after that, I think by the time we roll into next year, because summer's over this year, they made some good money, but by next year, next summer, I'm hoping everything is solved and we can start moving forward with normal lives. And that means there's treatments, there's vaccines, there's everything you need out there to combat that, and then Disney just takes off. Everybody starts going to the movies again, going to parks again, vacations, and like I said, the other revenue streams they have are just huge, and I think this company is going to go through the roof. And the final of Uncle Larry's 4 stock challenge that I'm going to go with. And you know, I love my Ethereum, but I didn't want to, you know, he said stock, so I'm going to stick with the company. Absolutely love it. Have a link down below to it. Coinbase is going to be a monster, and it's not easy to say, hey, we're going to start up an exchange and go out and beat Coinbase, who's public. They got money, they got everything, they're growing, everybody knows, and they're just going to be big. And I think as ETFs and other things start to come around for some of these cryptos, they're going to be there. They're going to be up in the revenue game. They're going to be doing a lot of things and staking and all that other stuff as it becomes more and more mainstream. I can't wait to see. And don't think, I would not be surprised if someday down the road I see Coinbase getting into the NFT market, somehow opening up a marketplace with Coinbase. You know, I could see all that happening. They are so big into that space. So the question becomes, if you think that crypto is going to go down, you stay away from Coinbase. But if you're like me and you think crypto is going to go to the moon, and you see the positives and how it's going to help society and all that, and everybody, all the big institutional buyers are starting to jump in, and it's starting to become mainstream for everyone's portfolios, and then you see the future, how this is going to explode around the world, then you buy Coinbase. All right, so that's how I did it, and I did add Coinbase. So
where they might spool up a drug and get denied by the FDA. So whenever you buy into a drug company, you want to make sure that IRR is above market. Market being the S&P 500 at 10%. This is double that. I think risk adjusted, that's appropriate. When I played with the revenue forecast a little bit, taking down the base revenue a little bit more, I got into maybe an 18% range number, but still very healthy double-digit number. I think it's a strong, strong number, and I expect good things for this company. If I put it into a distribution change, so if you look at this video 6 months from now, you're like, hey, I finally have the jack, what should I invest in? Well, if the stock is still in this $64 range, definitely go for it. As it increases, the IRR comes down, I'd be holding back. If for some reason it should fall, definitely be scooping up more. This is a solid good for me. It's my best rating. I like the stock. I like what management's doing. I like the track record of success. I like the large cash flow they're buying. Oh, by the way, one of the acquisitions they made, they paid $15 billion in cash for. So they are generating cash. They're moving the metrics. I like what they're doing. It's definitely a good buy to consider for your portfolio.
But on the other hand, the positives are they are a small company in a massive market. So the upside potential is big and the pathway to growth is really simple. Their historic book value and compounding rates have been historically very good. Therefore, returning to these levels will make a great investment. Management is doing a good job with debt levels, and the CEO has a big stake in the company, which I love to see. Then Monish Pabrai, a very smart investor who I admire and respect, now owns more than 5% of the company. Shinoken has a lot of signs of a long-term compounder.
The situation just a year later is that we have net cash, okay? More cash than debt on the balance sheet, which is great. So we're going to add $3.3 billion to come up with some of the parts equity value for Shinoken, 77 billion. So to get to the value per share, we have to divide that equity value by the number of shares outstanding. And they have 34,420,000 shares outstanding. So we get a value per share of 2,243 Japanese yen. Now the current stock price as of today for Shinoken is 1236 Japanese yen. So we have a potential upside of 81% just based on the value today.
I believe over a 5-year period, let alone a 10-year period, I believe you're going to wish that you had added this. So I have some things that have a past where you can chart it, like Tesla and especially Apple. So you can literally pull up a chart and see what it's done over the last 20 years. But you can't with ARK because it's only like 5 years old. But I like it because it has disruptive technology, fintech, gene therapy, biogenetics, autonomous driving, 3D printing. These are the things of the future, and I'm about investing in the future. Trends make wealth. Trends I would say trends will make a lot of millionaires if you invest in trends early. All right, good people.
So we look at revenue per share over the last year. It was about a 28% CAGR, or annual rate of return there. Now, the 3 years, it's 22%. So that's still really, really solid. I would say, really good companies over 10%, great companies over 15%, you're getting over 20%. That is just incredible. Now, earnings per share over the last year, they had a growth of 61%. That's fantastic. Over the last 3 years, their rate of return has been about 27%, or at least that's what their growth rate has been per year on average, is 27%. So those are excellent numbers. So whenever you see earnings per share actually growing above sales per share, that is an excellent sign. Another thing I really like to look at is return on invested capital. So basically that's net income divided by total capital of the company. And when I'm looking at a company, I want to see a 10% return on invested capital on average over the last couple of years. They're over 15%. That's really good. Over 20%. That's incredible. So if we take a look at Alibaba, over the last year was 17%. That's really good. Over the last 3 years, it was 15% on average. That is fantastic. Even when we look at their 10 years, it's 21%. So overall, their ROIC is just excellent. And keep in mind, ROIC is basically a measurement to look at management on how effective they are taking the income and then reinvesting in a company and building shareholder ownership or value overall. So very, very good. Like these numbers.
No doubt. This is very interesting, but here's the thing. These numbers are just based off of e-commerce growth. The growth rate is based off of e-commerce, and right now we know Alibaba Cloud currently doesn't contribute to the cash flow pile as it still runs at a loss, and the results of Ant Financial don't hit Alibaba's numbers either because it's a separate company. It's just a separate company that Alibaba owns a 1/3 stake in. So if you're bullish on cloud into the future and you're also bullish on Alipay, then the deal actually gets a little bit sweeter than the DCF numbers we just looked at. And I think ultimately that explains why a lot of super investors want in. Yes, there are risks, but as Monish Pabrai says, we're looking for those opportunities. Heads I win, tails I don't lose much. And from just a basic discounted cash flow, it looks as though Alibaba fits that statement. But of course, do not take this video as gospel. Definitely do your own research.
In my opinion, and part of the bet you make when you invest in Alibaba, is that this has been oversold by media and the typical analyst and investor in the Western world, and that maybe the macro factors and the regulations in place won't really affect the Alibaba business as much as most people think. So it's not to say there's going to be no impact. Clearly, we are seeing lots of step-by-step breakdowns and regulations that are really hurting the Alibaba business. I personally think it's not as bad as what most people make out, but it is part of the bet, and it's why you need to weight your investment carefully. Of course, you need to think about weighting with any investment, but particularly in China right now, you really need to think about the allocation and the risk and reward. I, of course, think the reward is far outweighs the risk, but that's your decision to make. And the risks are real on this investment.
All right, guys, now let's go over the two portfolios, and we're going to start with StockMo and Uncle Larry's first. Keep in mind that both portfolios have 7 stocks in them, and the prices that you see in the tables are prices reflected as of September 17th, 2021. So that is going to be the cost basis of each of these stocks as I track them going forward. All right, so now Uncle Larry and StockMo, this is their portfolio. First one is DraftKings. Second stock is Tesla. Third stock is Apple. Fourth stock is Walt Disney. Fifth stock is Coinbase. Sixth stock is ARK ETF. And the seventh stock is S&P 500. Now let's take a look at the value investors portfolio and see what we came up with. First one is Intel. Second one is Walgreens. Third stock is Lockheed Martin. Fourth stock is Bristol Myers. Fifth stock is Tulieve. Sixth stock is Shinoken. And the seventh stock is Alibaba. So which portfolios do you think are going to perform the best over the next few years? And how often do you want me to talk about these portfolios and give you guys an update? Do you want to see it on a monthly basis? Do you want to see it on a quarterly basis? Semi-annual? Annual? Love to hear from you guys. Don't forget to subscribe to my channel if you want to see updates to these portfolios going into the future. Thank you so much for watching. I'm really excited about this video series and see which portfolio wins. Thank you guys so much for watching. I'll catch you guys on the other side. Take care and God bless.